I was surprised to hear from some of these really big LPs that both they and kind of acknowledge that most other LPs in the ecosystem um, don't really care about exceptional returns. And maybe part of it is that they don't necessarily believe that exceptional returns are repeatable. So maybe you had a few good years, but it's maybe outside what they think is the right way to do this. So maybe they think that you're not going to keep putting up good returns. But even so, this guy acknowledged it. He talked about others, and I've heard it from others as well, that they're not looking for kind of a risky, unusual approach to maybe give them a 10x fund or something like that. They would much rather allocate to kind of big and proven managers that have a system that makes sense to them, and they're very happy with the 2x or 2x return or maybe 3x as a good outcome.
Hey everyone, this is Prashant and I'll be your host for the VC 10x podcast, and today we have Peter Livingston with us. Peter is the founder and general partner of Unpopular Ventures and has invested over $50 million in 300 plus startups across the world. This portfolio includes notable names like Jeeves, Zepto, and more. In this episode, Peter shares how they're unpopular even among LPs, some bold observations about limited partners from their fundraising efforts, how not having a thesis is a moat for Unpopular Ventures, how limited partners don't really want the best returns. Peter shares Unpopular Ventures' performance metrics and compares it with industry standards. We also discuss the power of compounding in venture capital and so much more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10x, where I help VCs start and run their own podcast. While I was running VC 10x, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Peter, so good to have you on the VC10X podcast again. How are you doing?
Doing great. Thank you for having me, Prashant. It's great to see you.
Yeah, it's a pleasure having you on. To start things off, can we have a quick brief about Unpopular Ventures and then we can dive in?
Absolutely. Unpopular Ventures is a venture capital firm and syndicate hosted on AngelList. We have invested $70 million across 430 companies since we started a little bit over 5 years ago. We focus on what we call the best companies off the beaten path. We're always looking for things that are a little bit non-consensus, kind of in places that no one else is looking, hence our name, Unpopular Ventures. And so with that, we really invest all over the world. We've invested in both in the US, but also Europe and Africa, Latin America, India, Asia, and beyond. So we're really looking to always invest in the very best founders and teams we can find, building high potential businesses, and preferably if they're doing something that's a little bit unique or new or kind of outside the bounds of what people have done before or where other investors are looking.
Absolutely, that's very interesting. And the question that usually follows after the first question is done that we ask our guests is, what's the investment thesis? But for this episode, we're going to change it a bit and we're going to discuss your lack of a thesis, right? Because I read your recent quarterly update the investing that you're doing, and there was this line that said that your outliers lie outside the thesis, right? And you're trying to follow that by not having a thesis. So let's talk about that.
Thanks for asking, and happy to share. And it's basically our thesis is that there is a market inefficiency in the way that venture capital as an industry works. And that the way that market inefficiency manifests is that everyone is really focused on ideas and markets. And so whenever VCs go out to raise money, one of the main questions potential investors ask is, what are you going to invest in? And the VCs all feel like they have to come up with really smart sounding answers about exactly what they're going to invest in. So they might say it's AI or cryptocurrency or B2B SaaS or fintech or digital health. Or so they come up with these kind of labels for that they hope will sound good to the LPs. And the way this kind of gets allocated is that the LPs end up allocating to a finite number of these labels or buckets or whatever you want to call them. And so the money goes in. The VCs are then locked into investing in these few specific areas, and all the money gets funded into them. And so what then ends up happening as this capital flows down is that the startups that fit a labeled bucket get pumped full of cash at very high valuations, and you usually end up with 10 or 12 of them for every idea there is, all extremely well funded, fighting with each other for customers and margins. And in contrast, if there's a really fantastic team building something really high potential that makes a lot of sense, but it's outside the bounds of kind of a bucket that has had money allocated to it, they're starved for money. No one else is starting a company there because they can't get money for it either. And when those companies that are off thesis actually succeed, they win big because there's no competition and no one else was trying to do anything there. And so we are big believers that if you focus too much on these theses, you're going to end up with bad returns because you're kind of going to the same places that all the other money is getting allocated to. Any thesis you can come up with that's going to sound good to the LPs is already going to have lots of money allocated to it. And we really believe the best investments through all of time were really out of bounds. They didn't fit any sort of defined thesis. And some examples of this are like when Bitcoin was a good investment, cryptocurrency wasn't even a label that people used. It wasn't a space people were investing in. It was just this new thing that was totally different. And it didn't look like a conventional business. It didn't have a team. It was going to produce profits and all this stuff. Another good example is Facebook. Social networks or social in general was not an investment theme at that time. And Facebook was unique on its own, but it had a really impressive founder, incredible traction. And Peter Thiel got a really good deal when he invested in it on 5 million posts when they already had something like 20,000 daily active users, like doubling every few weeks. Like it was like objectively it would have been a really amazing investment, but not everyone was jumping on it because it was kind of like it didn't fit what everyone else was looking for. And same with Airbnb and Uber too. More recently, marketplaces or sharing economy have become these defined theses that people want to invest in. But at the time those were started, they were also very unique. And so the way we invest is we're always trying to keep an open mind, just looking for the very best teams we can find, building things that make sense, that could be really big, and preferably we hope that it's something that's very unique and it's kind of outside the bounds of where money's getting funneled at a given time.
Absolutely. And I completely agree with that. I've talked to some LPs on the podcast, and they have said that they want to back VCs who have some sort of sector focus and sector expertise, right? And those are the ones they like to back. So at Unpopular Ventures, you have backed companies across different sectors, right? So a question that arises there is, as the GP of Unpopular Ventures, how do you get some sort of expertise into all these different areas these companies are operating in to make a sensible bet in them?
Yeah, happy to share. So the honest truth is we don't actually develop expertise in these areas before we invest or when we're investing. We index very heavily on the quality of the founders and their track record of success. And then after we invest, of course, we learn a lot more from the founders and become a little bit, more knowledgeable about it. But when we make an investment decision, it's really, does this founder have a track record of success? Are they credible? And then what they're saying they're going to build, does it make sense that it could be really massive? And preferably, especially if we're going to pay a higher valuation, we want to see some traction. And we're price sensitive in that way. So examples of this so we were the first investor in a company called Jeeves. Uh, uh, the founder there was really impressive, had previously co-founded and led a company to 40 million ARR. The company was part of YC. They achieved really remarkable traction while they were in YC. We actually found it before demo day. And so we were the first investor on 10 million post. And I haven't even said what they do yet. So what it is it's they're building kind of a global business bank, so a suite of financial services for companies that are international and operate in more than one country. And at that time, that was a non-consensus idea because the consensus view amongst most VCs is that all the best and most valuable companies are going to be created in the United States, and especially in Silicon Valley, and maybe New York City to some extent, but especially Silicon Valley. And it's just not even worth looking at global or anything outside the US. And so, although this one was technically a US company, it's headquartered in Miami now. They said we're going to serve all these startups that are outside the US and kind of do business across borders. And so that just wasn't an on thesis idea. And so anyway, they've done really well. Their last valued at 2.1 billion, growing like crazy. And so we did well with that. But I didn't have any prior expertise with global business banking or anything. It was just unique and off path. And good founder, good traction. Another example of this is we're the first. So we led the seed round for a company called Yassir, which is based in Algeria. It is the first company from Algeria to raise investment capital from investors outside of Algeria, and we were those first investors. What it is it's they started as kind of the Uber for Francophone Africa, which is a set of about 29 countries throughout Africa that are French speaking. Population of about 430 million. So it's kind of a subset of Africa that is kind of tied together through language. Um, and this was a case where the founder also was really impressive, had a track record in technology and of success. He actually, like, we don't require this or look for this necessarily, but he had so much conviction in what he was building. He put the first $1 million of his own money into the company to get it off the ground. Achieved extraordinary traction in that in his home market, and no one would give him money because it's Algeria. It's way off path. No one wants to invest there, and so we led a seed round at a very attractive valuation, and he's gone on to do really well. And um, I actually can't disclose the latest round, but it's going to be at a high price. They
Right.
have a ton of traction. They've become the top super app in all of Francophone Africa. And it looks like they're going to become, a super valuable, multi $10 billion company now. But we were able to do it because it was an area and a space that no one else wanted to invest, and because we're open minded and bet on this really impressive founder who was able to get a lot of traction in a potentially big idea. We've done well.
Absolutely. Thanks for sharing that. That's very interesting to learn. And uh, in the update that you had shared, in your quarterly update, you had shared that you were going out to LPs, potentially exploring raising a VC fund. And you had some very interesting realizations about LP behavior. And you made some bold observations on that, right? In that post. So I would love for you to share it here and tell us what are LPs actually looking for and what's peculiar about them, and why you as Unpopular Ventures are unpopular even among LPs.
Yeah, happy to share. So the context behind this is, so we have a setup where we don't really need to go out and raise money. So we have this rolling fund on AngelList. Our LPs there give us 1.4 million per quarter. It's a little bit more than 5.5 million per year. We're continuing to invest that actively. And then with our syndicate also, so we have one of the biggest syndicates on AngelList. We have about 4,800 LPs there that follow us. And for opportunities that where we want to invest more than we reasonably could from our fund, we'll write a memo, share it with our syndicate base, and raise more money through that, and thereby invest bigger checks into companies. And so through this kind of system that we've had, we're doing great. We've managed to invest $70 million in 5 years. We invested about 12.5 million last year. We did as much as 20 million during 2021 when the market was hotter. So we're doing just fine. But a number of bigger family offices or institutional LPs had kind of expressed interest. They said, hey, if you go out to raise kind of a conventional fund, not your rolling fund, for some reason, nobody wants to invest. None of these big LPs are comfortable with our rolling fund. But they said, if you raise a normal venture fund, please let us know. We'd be interested. And so we're now at this point where our numbers look extremely good. Both of our 2019 and 2020 vintages are valued at more than 5x money invested, which is very good for such a short amount of time. And then all of our other vintages are tracking really well too. So we thought, okay, we have a track record. We've gotten to a lot of good companies. Our numbers look good. These big LPs express interest. Let's go see if it would make sense to raise a conventional fund so we can get a little bit bigger. And I was extremely surprised that we were very, very unpopular with every big LP we talked to. And it was really funny. I went into all these conversations and they acknowledged that our numbers were excellent, among the best that they had seen from other managers. But we didn't talk to so many, but of the ones we talked to, every single one had some random reason, like a structural reason why they couldn't invest. So, for example, one of the big university endowments that's one of the most active investors in VC simply said, sorry, we're never going to invest in you because we believe that VC is a highly personal business where the VCs have to be located in a hub city like San Francisco or New York and mainly invest in companies that are in that location. And because you guys are, I'm in Miami, my partner's in Dubai, and we invest globally, they just don't think that that's a good idea. And even though our numbers look good, they're like, no, we don't think that's the right way to do VC, and we're never going to invest in it. And it's okay, that's fine. Also talked to a big one of the big pension fund, one of the biggest pension funds from California, and they had something similar. They said they are barred by the pension fund from investing in VCs that invest meaningfully outside the U.S. And because we do, they're out. And again, no issues with our numbers, no issues with our performance, but because of this one thing we do, they're like, nope, we can't invest in. And then there's a whole long list of other reasons, but it was just very surprising to me that I would have thought that a lot of LPs would just care about performance, and if you're putting up a consistent track record of good returns, wouldn't they just want to invest, or at least invest a little bit? But what I learned in this process is that most of them have kind of created a framework that they've decided this is the model of kind of the correct way to do venture capital. And we're only going to invest in VCs that invest in this way. And it has to do with where you invest, number of companies you invest in, ownership targets, all these things. And we discovered that the way that we're investing, where we're investing, how many investments we're doing, our focus on ownership, and a lot of other things too, is just really out of bounds for what most big LPs have decided is the correct way to do VC. And so anyway, it's funny. We completely fell flat with the bigger LPs. Feel very lucky that we have over 100 dedicated LPs in our fund already, and more in our syndicate, and we can just keep investing the way that we think is best. But it was just really a shock that we're so out of bounds for these bigger LPs.
Absolutely,
So,
that's very interesting. Yeah, go ahead.
I guess the last thing I'll share, and this is what I wrote about in our update, is it was a big awakening for us also that so we have consistently been putting up really good returns, like well within the top 10% of venture returns. And we'd kind of thought we think this is right. But, usually when you kind of consistently put up good returns, other people will kind of copy that and compete with you. And we had always thought, well, are we really going to be able to keep putting up these good returns for a long time? And what we discovered is that these things, how we're investing in a way that is kind of perceived as out of bounds for all the big LPs, this is actually our moat. This is why we are able to put up good returns consistently. And it's because it's not that other VCs don't want to invest like this. It's that all the big investors in VCs don't think this is the correct way to do it and won't fund anyone else, at least not in a meaningful size, to invest in the same way that we have been. And in a way, although I would have liked to raise tons and tons of money, I am also grateful that tons and tons of money isn't going into strategies that are similar to ours, which kind of gives us defensibility, gives us a moat. and means that if we keep investing in this way that most other VCs are not allowed to, we're probably going to keep putting up really good returns. So I am grateful for that.
Certainly, certainly. That's very interesting and kind of eye-opening for many to learn, because obviously you would think that if you're producing good returns, then LPs should be interested. You should be able to get them interested with good returns, right? Some LPs say that when you're writing to us, if it's gold, then just tell your performance numbers and then we'd be happy to take a meeting, right? But that's not the ultimate thing they are looking for, right? And one thing that was also written in your update was that LPs are not looking for the best returns, they are looking for good enough returns. So throw more light on that.
Yeah, I was surprised to hear from some of these really big LPs that both they and kind of they acknowledge that most other LPs in the ecosystem um, don't really care about exceptional returns. And maybe part of it is that they don't necessarily believe that exceptional returns are repeatable. So maybe you had a few good years, but it's maybe outside what they think is the right way to do this. So maybe they think that you're not going to keep putting up good returns. Um, but even so, this guy acknowledged it. He talked about others, and I've heard it from others as well, that they're not looking for kind of a risky, unusual approach to maybe give them a 10x fund or something like that. They would much rather allocate to kind of big and proven managers that have a system that makes sense to them, and they're very happy with the 2x or 2x return or maybe 3x as a good outcome. And I think part of it is just that most of these big LPs are not single individuals. They're big teams and hierarchies where if one of these junior people invest them in the next benchmark that doesn't exist yet and they put up a really good return, they're not going to really, okay, sure, they'll get a pat on the back, but they're not going to be praised that much for it. In fact, those returns will happen in 10 years. They probably won't even be there anymore, especially if it's a junior person making these decisions. And then even if it is a 25x and they invested maybe 10 million in that fund, but this is a $500 billion pension fund, it's not going to move the needle for them. So instead, it's really much more of kind of an allocation exercise where they're just trying to kind of make sure that you're kind of producing market returns or maybe slightly above market. They're going to put some in public equities, some in bonds, some in real estate. Venture capital is another asset class. Let's put some in there. And if you simply get about the same returns from that as everywhere else, and you don't make huge mistakes, then that whole organization hierarchy is happy. And so with that in mind, there's the famous saying that nobody got fired for investing in IBM, or no one ever got fired for buying IBM. And in the same sense here, if someone takes a risk and gets that huge return, it won't really matter to them. But if they take a risk and make a mistake, maybe end up with a zero or look stupid, they could get fired for that. And so it's much safer for a lot of the junior people in these hierarchies to invest in the Andreessen Horowitz or Sequoia or even Tiger for that matter, just a big brand name that everyone else is investing in. Because even if the returns aren't good, it's like, hey, I did the same thing as everyone else, and they're not gonna get fired for it. So it's a funny dynamic, but
Right.
I acknowledge that that's how it works, and we're still new, and we have some track record, but we're not, we haven't been around for that long. So I can understand that we're still perceived as risky to a lot of these bigger pools of capital.
Right, absolutely. So even though LPs say that they are allocating to VC, which is obviously a riskier asset class compared to the other asset classes they are investing in, but still they are trying to do it in the safest way possible, right? They want to protect their money as much as possible and not lose it. And the people who are doing it are, and their intentions probably are to not lose their job. That's the main intention there. Best returns is the upside, but they want to protect the downside first, right? That's important for them. Right.
I think that's exactly right.
Awesome. And you must have talked to different types of LPs in the process, right? So
Mhm.
you mentioned pension funds and wealth funds, different types of funds, or there are even fund of funds, right? So
Mhm.
from these different types of LPs, uh, which one do you think has the appetite to take the most risk, or maybe how do the approaches of different types of LPs differ? If you could tell us.
Yeah, happy to share. So I talked about there are tons of different kinds of LPs. There's endowments, um, pension funds. You mentioned funds of funds. There's family offices, um, and they're all different. I think the ones that take the most risk are effectively family offices because that comes down to individuals or a small collection of individuals that kind of just invest in what they like. And the reality is most of our existing investors are family offices or just high net worth individuals. Um, and some are big, but but in general, most family offices are smaller than, say, a university endowment or especially a pension fund. And so there's kind of a limit to how big you can get with just family offices. Um, one of the interesting groups to talk about is the funds of funds. So I wrote about this in our LP update as well. So I talked to several of these. They all hate us, and it's funny. It boils down to a very specific thing. They really care. So what these are funds that raise LP capital and then invest in venture funds like us. And they charge fees on top of the VCs. So they usually take a 1% management fee and 10% carry on top of the typical 2 and 20 or whatever it is for the VCs. And they don't like us for a they all consistently don't like us for a very specific reason. It's that one, we don't focus on how much percent ownership we own in each company we invest in. And two, we invest in quite a few companies. So a lot of them want to see that the VC invests in like kind of maybe 20, 30, maybe 40 core companies. We've invested in 430 in 5 years. And they really don't like that for a very specific reason. These funds of funds invest part of their fund into the VCs themselves. But then a big part of their strategy is that they hope that those VCs will produce winning investments, but the VCs will run out of money, but they'll have big ownership in these companies with what's called pro rata. It's kind of the right to defend that ownership by investing in future rounds. And these funds of funds will then take these winners and basically take over the pro rata and invest directly in those companies for free without any fees. And that only works if the VCs they invested in have pretty high ownership so that that pro rata is meaningful. And also, it matters to them that there's not too many investments for them to keep track of. If they're trying to keep track of 400 companies across 20 funds that they invested in each, they're just going to be completely lost and they won't know, okay, which are the ones that we take over and jump in and do the pro rata for. And so because of that, because we're not focused on ownership percentage and we have too many companies, we just don't work with their strategy that they're hoping to kind of get this free ride and take over our best investments once we run out of money. And so we got rejected from every single fund of funds. They didn't all say it, but that is effectively the reason. They all really focused on how much ownership are you getting, how many companies are you investing in, and once they learned our approach, they were all immediately out.
Right. Yeah, that's very interesting to learn again. And so you mentioned about fund performance, right? That's we have hinted on that, but not talked directly about that until now, right? So let's talk about the performance. So you have invested across 5 different vintages now. How is that shaping up in terms of performance and some metrics? If you can share, that would be great. And then if we can try to compare it with the average VC performance metrics, and then that would give us a sense of how your strategy is performing in comparison to a focused strategy that LPs like.
Yeah, happy to share. So we've invested. The reason we think of this in vintages is that we don't have this conventional fund. Our rolling fund, we invest quarter by quarter, and then our syndicate, we do one-off syndicates all the time. And so to kind of organize our track record, we focus it on years. And so we have 2019 through 2023 that we can kind of track and measure now, and uh, it's looking very good. So our 2019 portfolio is already valued at 5x money invested. 2020 is at actually about 6.5 to 7x. 2021. So those two are fantastic. They're older. They've had more time to mature. Some of the big drivers of that are Yassir from 2019. There's another one from that year that's really big that's about to become a unicorn too, but they're being very secretive, so I can't name them. Both of those companies have just a tremendous amount of traction. We actually think they're undervalued with how we have them marked. And so, although it's a 5x for that year 2019, we actually think that it's actually probably potentially even more than that. 2020 as well is heavily driven by Jeeves. That was the year we made the first investment there. We've got a few other really good ones too. But Jeeves is worth about 4x out of that 6.5 to 7x. So it's hinging significantly on that. But Jeeves is very healthy, doing great, has a lot of revenue, growing really fast. And so we think that mark is legitimate or close to legitimate too. More recent years that haven't had as much time to develop, 2021 is valued at 1.7x. 22 is valued at 1.5x. And 2023, which was only just last year, is already valued at 1.2x money invested. And you asked kind of what this compares to. And so within the overall VC market, the median venture fund returns about 2x after 10 years. Everyone says they're targeting kind of a 3x return net, but only, it depends on the size of the fund, but across all sizes, only kind of a single digit percent of funds actually produce a 3x. And so this, comparatively, the fact that we already have two vintages that are above that 5x, that's extremely rare. Like it's kind of definitely within the top 10% of venture funds and probably within the top couple percent in terms of performance. And then our more recent vintages too, comparatively, to have 1.7x from 2021, which was a very highly valued year. Tiger, their 2021 year is supposedly down like 40 or 50% already. For us to already be at 1.7x in terms of kind of marked up value, it's very good. So I guess I'll pause there. Did that make any sense, or
Yeah,
should I clarify
it does.
anything?
It sure does. It sure does. And you're talking about UVPI, is it?
This is so yes. So this is actually MOIC, multiple on invested capital, and I could translate
Right.
this to TVPI. To translate it to TVPI, you have to take off about 20%. To do it net, so net of carry and everything. The reason we do it as MOIC is because the syndicate is sort of different from a conventional fund, and all of our dollars in those years were from the syndicate. But if you want to do apples to apples, you basically take off about 20%. So the 5x would be maybe a 4x in terms of TVPI, and the 6.5x would be five something. So still good, slightly less.
Mm-hmm. Sure, that's very impressive there, right? And let's talk about this time where you had an opportunity, an exit opportunity for a portfolio company for a 2019 vintage company, where if you were to do that, you would get a 1.5x return on the entire vintage just from that one exit, right? And you refuse that. So tell us about the thinking behind that and why you refuse that.
Yeah, well, so at a high level starting point, my partner and I are just really big believers in the value of compound interest over a long period of time, or maybe not compound interest technically, but compounding growth. And the way that I like to illustrate this is that if you could just manage to invest in a company that doubles in value each year consistently, that's kind of the dream of VC. Simplifying it, obviously, it's more volatile than that. But if you could just get in on one that kind of goes to 2x after year one, 4x the year after, at year 5, you have a 32x, which is a huge return. I mean, that's a home run by any meaningful standard. And a lot of people would say, wow, I got a 32x in 5 years. Boom, I'm going to sell it, bank to win, and fantastic. Great. But here's the thing. If you hold that investment for 10 years and you're lucky enough to have it keep doubling, in 10 years, it's 1,024x. And so getting a 32x instead of 1,024x by waiting just an extra 5 years means that you left 97% of the returns on the table by selling early. That's how, literally, not even just most of the returns, you left 97% of the returns on the table by selling this thing too early. That's how powerful compounding growth over a long period of time is. And so, even at a slower rate of growth, just the way compound growth works is that the latest years create the most value. If you're growing 20% a year, or even like, and you do that for 3 or 4 years, you more than double the value that you have. And so it's really important to hold these investments as long as possible, capture that compound growth. And so to this company specifically, we've received secondary buyouts for it at a unicorn valuation. We invested very early, at a valuation in the teens, and we could take it. We could return a bunch of cash to our LPs. I'm sure they'd be happy about it. But we really think the company's undervalued. It's growing really fast still. They have a ton of revenue. And we really think that in another 3 to 5 years, it could easily go another 10x, 20x, maybe even 30x. And gosh, we'll feel stupid. And I think our LPs will be upset too if we sold it now for the 1.5x and then look back and realize, wow, we could have given them a 20x in a few more years. And, maybe we'll be right, maybe we'll be wrong, but we have a big portfolio. We have other ones that are
Right.
behaving like this too, where, maybe it's 50-50 if this one actually delivers the 20x instead of 1.5x, but we've got another one that is also probably 50-50 and another one as well. And the best thing to do is to hold these. And I really believe that at least one of them is going to produce this giga return, and it's going to pay for everything else many times over. And we'd rather hang on for that.
Right.
As we said to our LPs in our update, we're not really here to kind of be an allocation in a diversified portfolio like these big LPs are looking for. Like, we are doing this because we want to make life-changing money for ourselves and our LPs. And the way we do
Right.
that is we hang on for these super giga grand slam type outcomes. And
Right.
requires a little more patience, but we really believe we're going to do it. And that's the best way to serve the interests of both our LPs and ourselves too. We're here
Right.
to make this life-changing money for everybody.
Absolutely. Yeah, that's a very bold move there, and hope it pays out. And one question I wanted to ask you is that VCs have this 10-year time frame within which they have to close out the fund, right? They have to return the money, right? Does that hold true for syndicates as well?
Yeah. So most VC funds are set up to invest for 10 years. The reality is that, especially from seed stage, most of them actually extend that to 12 to even 15 years. It just takes a long time for companies to go from seed to IPO or other liquidity. We have always said 10 years to our LPs, and so we'll generally aim for liquidity within that time. Um, but we'll see when we get there. So I think there's also kind of a divergence between what we'll do for our LPs and what I intend to do personally. So, for example, this company that we could have sold for 1.5x, but I think is going to go to at least 20x for the whole vintage. I think they have the traction where they will probably IPO in the next few years. And when that happens, so the way that'll get paid out to our LPs is, so when they IPO, we will basically take all the shares that we receive in the IPO. We get a portion for our carried interest. We get about 20%. And then we can basically distribute the rest of the shares out to all of our LPs. So at the point that it becomes liquid like that, we can all independently decide what we want to do with our investment. So we'll distribute it to the LPs. If they want to sell it for cash, they can, great. But for me personally, I actually intend to hold these shares for as long as possible. I'm going to take my carried interest in shares and just hang on to them. It was recently in the news how two of the Sequoia partners who led NVIDIA's seed round are still major shareholders in the company to this day. Like, they took a little off the table when the company IPO'd, but they still hold the rest, and each of their positions are worth like into several hundreds of millions, or no, I think it might actually be in the billions now. And they held on for like 30 something years. And when I read about that, I'd heard about it also with like John Doerr, who's still on the boards and major shareholder in Google and Amazon. And I think that's really, like, I love investing. I'm a very patient guy. I'm fortunate to not need this cash immediately. You know, I'll probably kind of sell a little bit as time goes on, but really, reading about these made me realize that my dream as an investor, the thing that I feel like I'll be really proud of in my career, is to be like those Sequoia partners that held NVIDIA for 30 plus years. And so maybe this company specifically, or maybe one of the other ones, is going to be this one that compounds and compounds over decades and becomes $1 trillion company. I don't know which, but my goal as an investor is to get in on a couple giga winners and just hold them forever, Warren Buffett style. So So that's what I'm going to do. But we'll give our LPs the choice when we can. We'll distribute the shares to them, and if they want to sell, they can. But I personally am really a long-term holder, and I really believe in the power of compound growth over a long time.
Absolutely. Yeah, that's beautiful to learn, right? And you have invested in close to 500 companies in just about 5 years, right? You have access to so much of data and you have seen so much of game film within your portfolio, massive, massive portfolio. Tell us, what are some trades in the startups that can be observed early that are key determinants of success, right? In companies that are more likely to succeed, what were the things that they did right early on, or what were the traits that could be spotted on early on about those companies? And also on the flip side, if you could share also for the ones that didn't work out, what were the traits about them, right? That'd be great.
Mm. I would say it's really, really hard to tell. So I and my partner have been at this for a long time, even before UV. I've been angel investing personally since 2012. I've been surprised at the failures, and I've been surprised at the successes. And even now, with all this experience, I would have thought, okay, now I'll kind of know what are the good ones and what are the bad ones. And maybe my judgment has improved some, and maybe when I build a portfolio, the returns are a little bit better. But even so, the thing that we've actually chosen to do as time has gone on is to build a bigger portfolio every year than we ever did. And it's just, we both know that it's really hard to tell which ones are going to win or not. And also, the winners end up so big, the power law is so powerful that it's more important that you get in on one of these companies that returns 1,000x or 5,000x, even if it's one of 500 companies, than it is to invest in, say, 10 companies and get a lot of ownership. And so that we think the returns of kind of increasing the chances you get in on an outlier, even from a massive portfolio, we think those returns are better than if you really concentrate in on like 10 investments and try to get a lot of ownership. Um, it's
Mm-hmm.
just because that power law, that those winners really run so far if you get on one of those rare ones. And
Right.
so the approach we've taken is that as we've gotten wiser, is we still don't think we know anything, and the best thing we can do is invest in as many companies as we can.
Yeah, that's interesting. And you have an interesting take on ownership targets, right? So most VCs I've interviewed have an ownership target, and most LPs, obviously, like you said, want you to have an ownership target. So you're saying that you don't have any ownership targets, right? So what does that mean? So you also going to invest if there is like you're getting an opportunity to get like 1 or 2% in a company, it's a good company.
Yeah,
So are you going
or
to
less.
still invest? Yeah, you do.
Well, I'll tell you the formative experience that I had that led me to not care about ownership. So
Mm-hmm.
I don't care about ownership, but I do care about potential. I do want to see that the investment has a plausible chance of returning at least 100x and preferably 1,000x from the value at which I invest to what it could be net of dilution. So if we think that the potential outcome is going to be small, then yeah, we have to invest at a small valuation. But if we think the outcome could be $1 trillion company, then sure, we'll pay a higher price. And so my formative experience in this vein is in my angel investing career. My best performing investment I did at a $3.5 billion valuation, and do you know what it was? It was Bitcoin. So 3.5 billion sounds high, already kind of effectively unicorn. At that time, all the Bitcoins in the world were valued at 3.5 billion. I put 5% of my fund in that. And I won't talk about what I have now, but anyway, now Bitcoin is worth 1.3 trillion or 1.4 trillion in a very short amount of time too. And that's a case where if I had been like, oh, I need to own like a percent of this or 2% or whatever, I wouldn't have done it. But ironically, the investment I did at the highest valuation at the lowest ownership was also the thing that made my entire portfolio several times over. And I've really taken that to heart. If I have the chance to invest in, let's say, something that I really think is going to be an Uber or a Google, and the valuation is going to be 500 million, and I'm going to get a fraction of a percent, it's still worth it to do it. An example in our own portfolio right now is actually a company called Zepto in India.
Yeah.
We're only able to get 25K into their seed round on 13 million posts. We are still so our ownership is tiny, probably especially with dilution. It's probably like 0.1% or something like that. I haven't looked lately, but we're still so happy to be in that. They were last valued at 1.4 billion. YC has said that it's the fastest growing company to go through YC ever. I don't know if that's still the case, but they were saying that at one point. It seems like it could become effectively the Amazon of India. Maybe it'll be India's first $100 billion company. And in that case, we're totally happy with that we even got into it. Even with a tiny check, it's going to return our fund many times over. Um, we got in at a low valuation, but it was a tiny check. So I
Yeah.
think that focusing too much on ownership can often really screw you up from making the best investments. If you see a company that you think is, the next Uber, the next Amazon, or the next Google, but they're not going to let you get your ownership target, should you invest or not? Well, of course you should invest. And so anyway, that's why I think the whole ownership thing is stupid. I understand why the
Right.
funds of funds care about it because they want to do
Mm-hmm.
this whole pro rata thing and invest more. But in terms of producing the best returns, I really like what Semel Shah has always said. He said, the most important thing as an investor is to do good deals. DGD. Yeah, do good deals. And that's what I believe too. Do good deals that are high potential. And it doesn't matter how much you own as long as you're in really good deals.
Right. And you don't do any pro rata at all, right? You're not going into follow on rounds. You
No, we
are?
do. We do.
Okay.
Yeah. Yeah, we try to size up in the ones that we think are most compelling. And
Mm-hmm.
we don't always get it right, but we are right some of the time. And we do base that on execution, traction, and kind of founder mindset. So as we get to know them more over time and see how they're
Right.
thinking about the problem and the opportunity, we can build higher conviction.
Awesome. And yeah, you were talking about Zepto. So that's been a very interesting story. Even I'm here in India, so I've seen it build firsthand. And it was almost like a landslide category creation startup. And now it's facing fierce competition from
Mm.
the big wigs of Zomato. They have launched Blinkit, which is a direct competitor of quick commerce, which was a category I believe Zepto created. And that's massive because these were two 17, 18-year-old guys who were doing this, and they have done this at such quick pace, and they have forced these big companies to look into this space, and now they are also operating. So that's massive. And Zomato, the company that went into this looking at Zepto, now their quick commerce business is actually bigger than their main business, which is Zomato. So, and Zomato is a publicly listed company here in India. So that's the things are heating up, sure, but what Zepto has pulled off is commendable by all means, right? And way to go for them.
For sure.
Yeah. And my last question before we close this out is, what's something that you've learned now that you wish you had learned 5 years back?
5 years back, what do I wish I learned now? Well, that's tough. I mean, I am always learning, but a lot of kind of the core things I really believe. Well, I think I've just developed more conviction in some of these things in the last 5 years. So I talked about, we've actually increased our portfolio size because we really believe that it's more important that you increase the chances of getting in on a Zepto or a Giga winner than it is to have a lot of ownership in just a few companies. Just because the winners really, really run. Like it's really counterintuitive. Like most people cannot grasp just how far the super Giga winners can go. Um, I think another thing that I've internalized, I kind of always had a sense for this, but have really seen it up front a lot more is just how volatile a lot of these things are. We have a lot of companies where we either thought they were guaranteed winners and then kind of stumbled and crashed and burned. And in contrast, we've had ones that we left for dead, and then somehow the founders pulled through and got the traction and raised the next round and it kind of rose from the ashes and have done really well. And I actually here's an interesting thing that I'll share. So most so startups are always private, I think for a very good reason. And it's that the perceived value of them over time is extremely volatile. It fluctuates up and down a lot. And if they were in the public markets, it would just be too psychologically hard on the employees and the founders and the investors. It would just be a huge roller coaster ride. And by being private, not having to share tons of information, they can kind of sail through that extreme volatility of the startup journey. But what's been really interesting to see is that cryptocurrencies are actually startups effectively, and not all, many of them are just scams, but the big ones are effectively startups that have been public from the outset. And if you want to understand the volatility of the startup journey, look at the chart of Bitcoin price since inception. And you'll see like it shot up several times, dropped 75 to 85%, at least 5 or 6 times over the course of its journey. It's been declared dead hundreds, if not thousands of times now over its 15-year journey. And somehow it arrived at where it is at an over $1 trillion valuation. And when you look at that chart, that is actually the journey that most startups go through. It's just you can't see the price chart over time. That is the volatility of a startup. And I don't know. I think it's neat that most people kind of on the outside don't know, they can't see all the ups and downs of the startup journey, but that's a case where you actually can. And if you look at that and you understand that is what the journey of most startups actually looks like. I think a lot of people really understand and maybe respect more what the founder and startup journey is really like. And as an investor too, but less. It's much harder being a founder than it is being an investor.
Totally, totally. All right, this has been an insightful conversation. And now let's do the rapid fire round, wherein I'll ask you 5 quick questions about the investing you're doing, and you have to give 5 quick answers, right? First one, what are the sectors and regions you invest in?
US, Europe, Africa, Latin America, Asia, India, Pakistan, literally everywhere.
Typical stage of investment.
Pre-seed and seed.
What's the typical check size you put in?
We do a lot that are 25 to 50K, and then we size up in some as much as $500,000 to $1 million.
Awesome. Where can founders apply for funding or get in touch with you if there's a direct way?
Warm intros. We have a huge network. We have over 400 portfolio companies. So
Right.
over 400 portfolio founders, or probably more than that if you count all the co-founders. We have 4,800 LPs. You should be able to get in touch with one of them and have them refer you in.
Absolutely. There's a massive network out there, nodes finding deals for you, right? Awesome. Last one. Where can our listeners follow you?
Well, so I post all of our updates on LinkedIn and Twitter. You're welcome to follow me there. And then if you want to invest with us, come find our syndicate and fund on AngelList. If you go to our website, unpopular.vc, that has links out to our Twitter, LinkedIn, and AngelList pages.
Awesome. I'll make sure to put all the links in the show notes below. Thanks so much for doing this with us, Peter. It's been a pleasure having you on again. Thank you.
Thank you so much, Prashant. It's great to see you, and thank you for having me.
My pleasure.